Chart of the Week with Redmayne Bentley.
You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley. Bill, we've got a couple of underlying instruments we want to look at today with three charts. We've got two charts on Lonmin and then one on the US dollar. Let's start with the first Lonmin chart. Why have you chosen this, Bill, and what are you expecting from it?
Well, the Lonmin is intriguing. So I was told the show before we were recording actually where Lonmin. The first chart we're looking at is the 5 and 20-day crossing, and this is a short-term indicator. This is a short-term indicator which will allow you to sort of get into puts or calls depending on your trading style. And look at the chart on the we've got here is we've got an MACD which is suggesting that the market is well in long-term downtrend for Lonmin, and the 50-day and 200-day is turning lower. So the longer-term chart is and has been rather tricky for some time. But interestingly enough, on the 8th of September, where we see a move from on the chart there, a green to a red shading, that's where the 5 and 20-day moving average crossover occurred, and that was in the height of the bid from Xstrata coming through.
Right.
And that was at £33.19. And since then, the share price has plunged to the low depths of about £6. So it's quite an extraordinary fall. Now, if you were to go back in time and look at the last edition of this broadcast with you, Giles, we did actually touch upon Lonmin at the lower end.
Yep.
Where the RSI of 2, less than 2, and that came through around 620 odd, I think.
Yes, that's right. I remember that.
Yeah. Now Lonmin's now pushing towards £8.47, and there's some good money to be made there on that.
And you would advocate the covered calls?
Well, I would say if you're an aggressive, there's three parts to all the trading strategy. First of all, is piece together the jigsaw. Is first of all we have to have a trading strategy, like a 5 and a 20, or an RSI of 2, less than 2, and the relative strength less than 40 against the market. Or weaker than 40%. That's what we like. That's what I've looked at before, and that's why I came up with Lonro, Rio, and Xstrata as signals last time. And that is certainly, I think, that is the first earliest stage you can get into the market. The second stage we're looking at now is the 5 and 20, and this is where Lonmin's crossed now. It's crossed today at 5 and 20, and it's up 5% today, indicative that there's further upside until the next hurdle, which might be around the £7 or £8, or indeed the £12 level, depending on where it wants to go. And with this strategy, yes, it's good picking up warrants. And the second part is to find out what could you make out of this, and it's to say what product do you buy in order to maximise your gains. I always liken it to going to the pizza shop. And the third stage is liking to the pizza shop. You've taken your strategy, you've taken your product, and you look at taking overall, and you don't like the thick-based pizza, and you've gone off the whole thing altogether. Whereas the thin base would have suited, but the fact that you tasted the thick base is you've gone off the whole thing altogether. So, if you sort of mean, it's very important to get this, to have an understanding that the system, even though you might incur losses, is good, it's speculative, it's fairly aggressive. And the underlying product you choose is very, very important to have the right one to maximise these gains, because they can become these moves can be quite violent, they can be very exciting, and you must have the temperament to cope with that. And I said last time you could actually go for long term on these, and long term you might have missed out on the on the Xstrata move because you might be holding on a bit longer. It's already the underlying warrant on the Xstrata has been up 40%. And it's trailed probably parity now to when the signal came in. So one has to be relatively nimble as to how one wants to trade here.
Okay. Now you've, which is good advice, Bill. Now you've also sent us a second chart on Lonmin.
Yeah.
What's the point of this one? Why have you sent this one?
Well, this one, the second chart on Lonmin is gives you an idea of what this is against the sector, what's actually going on with the share. So let's take it from the bottom here. I've put volume at the bottom here, which actually shows that volume is increasing. It's a simplified volume, and it's like an OBV version of OBV. And we're seeing here that the volume is actually picking up against the moving average. So it's against the moving average, volume is picking up. The reason why the red is come up on the bottom bar there is because the share is still underperforming its sector.
Right.
It's not outperforming the sector.
Right.
So it's still underperforming the sector. So we have to remind ourselves here that this share is not a strong player necessarily, and it's underperforming by about 15-16%. And it's not that strong. So we have to be aware that we are dealing with quite a dangerous situation. On the top end, and this is going to the top, we've got the inverse fissure, which actually is RSI normalized, which suggests now there is some strength coming in here. This is quite good. Not often we've seen many shares go above the minus level, but it's actually gone better than that. It's heading towards near the positive end. So this is actually trending short term quite positively. So I'm encouraged by that. The only thing that concerns me, or one of the things that concerns me, is the second indicator down there is a B indicator, looking at also the trend strength. Trend strength is quite strong, but I think this is a negative strength. And why I say that is because I'm looking at the Q indicator, which is well below the minus 10 level, which it's indicative that the longer term trend is still down. This very much is a short term signal, and is there for traders only.
Right. Okay. So if you're not interested in trading, don't buy. Absolutely,
but the upside is £10. The downside, I would use a stop, quite aggressive stop, about £750 or £8. So this is a traders only, and this is what this market can well be. It is a traders market. The mining stocks are underperforming the market generally, and it's not a good sector necessarily for those who are shy of losing a few bob if you're trading. Yep.
Okay. Right. Now, the next chart you want to look at is the US dollar index. Mm-hmm. Now, the US dollar has been very strong this year.
Yes, it has been.
But what are you seeing now? Are there cracks beginning to
change? Yes, this is what we said before. Is that the US dollar is starting to weaken against the basket of currencies is against, and this has occurred early December, and this is in full flow at the moment. So this is where, again, the 5 and 20-day moving average crossover came in, and we saw in July. This is what actually spooked all the commodities. The 5 and 20 crossed over, we went green, and if we looked at the oil price at the same time, it probably turned over and went wrong and hurtled on the same basis. So I would have thought that we'll look at next time. We're going to see some movement on the oil price on the upside, and certainly some of the commodities we're looking at should be going up as well. Gold a smidgen higher today. Platinum has reversed. We looked at platinum a few weeks back. Well, silver's a little firmer. We're actually seeing the commodities coming to vogue here, and as the dollar weakens, which is very good. This is going to help an inflationary result rather than a deflationary result. In bad times, historically, recently, we've seen the dollar get stronger as the yen's been getting stronger as safe havens are coming through. But now, with interest rates are weakening and almost at zero, going towards zero in America, the propensity to holding on to a US dollar is becoming much less. I think with all the debt building up there, and the prospect of no recovery necessarily coming through, this is going to sort of favour a weakening of the dollar. And then, of course, I think we'll see this one come back probably to the 70-71 level. So this is good news potentially for the commodities and for the inflationary scenario if that trend continues.
Very interesting, Bill. And when these currencies turn, they seem to turn quite quickly, don't they?
They are. They cover cool warrants on these things as well, and the gains can be quite substantial there. We've seen enormous gains on these, but I want to stress the two indicators on the chart above the US dollar index. We've got the 50 crossing the 200-day. That still suggests the long-term trend, and the MACD is still positive, even though we've got the short-term indicators, the 5 and 20 crossing over. The longer-term trend is still in place. When they start turning over, we can see some change, but they're very lagged, as we can see beforehand. The 5 and 20 came through in late July, yet the MACD and the 50 and the 200-day came through in late August. So, I mean, the longer-term trend is still positive for the US dollar, but the short-term trend is indicative that there's a change ahoy.
Bill Rook from Redmayne Bentley, thank you very much for those insightful comments. Always a pleasure chatting to you. You have a great Christmas and New Year, and we will speak again on the 5th of January.
I look forward to that. Thank you, Giles.
Chart of the Week with Redmayne Bentley.